Hi, this is Tony Kipreos from Axiom Financial Group. Thanks so much for joining us today. In today's video, we're going to discuss some of the advantages of private market investing compared to public market investing, especially when it comes to volatility. Stay tuned, and again, thanks so much for joining. There's a lot of different advantages and differences between public market investing and private market investing. One key advantage, which can be seen especially during volatile periods in the public stock market, is private market investing can sometimes take the emotion away from investing because the private market assets are not priced on a daily basis. Unlike public stocks, where you see the price go up and down throughout the day, and every single day there's a price associated with it, a private market investment typically only has a price associated with it maybe monthly, maybe quarterly, maybe annually, maybe only when there's a private fundraising round that rearranges the price on that asset. So there's one key advantage to private market investing, is that you can't sell that asset on a daily basis the way that you can with public stocks. You give up some illiquidity there, which can be seen as a negative, but on the flip side, it can be seen also as a positive because it takes the emotion away from being able to sell an asset that is fluctuating throughout the day on a price change. When private market assets, they don't do that. So for example, if you're investing in a private equity fund, there's no daily price. So in January of 2022, when the market was volatile, it ended up being down over 5%, the S&P 500. There's no way that you can sell your private market funds or sell your private equity funds during that volatile period. And that's actually can be seen as a great advantage because it doesn't allow you to use your emotions and sometimes sell when the market is down when you should have been buying, or selling at a bad time when you should have just left it alone. So private market assets help a lot in that regard because it takes the emotion away, because the assets aren't priced daily, and so it doesn't allow you to sell daily either. So some of the private markets are to some degree illiquid, but there's a reverse positive to that illiquidity, which I just mentioned. Another interesting positive about private market investments, especially private equity style investments, is that they invest money over a multiple year period, typically via capital calls. So let's just say you invest $100,000 in a private equity fund. It's a 5-year investment period. Let's say they call capital 20% per year, so $20K a year you're giving to the fund when they find deals to invest in. That's like a natural dollar cost averaging, which is a term used in public market investing when you invest in a stock market index or mutual fund on a consistent time period basis. So it smooths out the prices and the time periods in which you invest. Private equity investing is designed to be a natural dollar cost averaging. So you're investing money over many periods, typically over multiple years, where sometimes private equity markets are highly priced, sometimes they're lowly priced, sometimes they're average priced. And this can be also a great advantage because you're not trying to time the market, because the way that you could do with public market assets, because you can sell them daily upon your request or upon your emotions. So another advantage of private equity investing in private markets is the fact that you can you're investing money almost like dollar cost averaging over many years, and that kind of takes the emotion away from the fact of when prices are high, when prices are low, trying to time the market from that manner. So these are kind of two main advantages of private market investing, and I wanted to talk about those because I think they're very important to know about when you compare it to a public stock market volatile period like we've just had in 2022 here in January and February, where the market's down 9% on the year and 5% in January, and I'm talking about the S&P 500 index for those numbers. So anyway, I just wanted to highlight those 2 points, and thanks so much for joining us today, and please stay tuned for our next video. Take care.